So good morning, guys. Uh, Welcome to the second day of SAP Financial Accounting or Financial Accounting Basic walkthrough. So, permit me to just share my screen and then let's start. I'd like to also have a question before we start. 1 minute. Can you see my screen now? Okay. Can you see my screen?
Yes, sir.
Good. Good. Before we start, can someone just give us a recap of what we did yesterday? So, so can someone give us a recap of what we did yesterday? Hello? Kudirat, can you give us a brief of what we did yesterday? Okay, let me just talk about the recap of what we did yesterday since one is trying to. So yesterday, we started with the basics, with the financial accounting basics, where we talk about the structure, the terminology, the concepts, and the accounting principles. And we gave a brief introduction of what accounting is or what accounting means when we talk about systematic recording, analysis, and reporting. And we delved extensively on the importance of accounting in business, where we talk about the mean your business health, better business decision, avoiding business collapse, access to loan or investment, paying the right taxes, planning for the future, preventing for theft, and we were able to even share some of the historical events of what we have had in the past concerning or with regards to keeping records, which every one of us shared their experiences here. So I will talk about the overview of financial statements. We'll talk about P&L statement, and we'll talk about cash flow. And we're able to also uh, give details or make or speak to the details of what assets implies. When we say we talk about current assets, talk about non-current assets. We talked about liability as well. We talk about non-current liability and current liability. So these are the things we spoke to yesterday, and we also gave a story. We talked about the component structure of an asset. We talk about what's in assets, under current assets, the cash parts, the accounts receivable, the prepaid expenses, inventory, and we're able to explain all these things in details. We're able to also explain what non-current asset is and what we meant by non-current assets and what constitutes non-current assets. We talked about the property, plant, equipment. right? And then we talk about liabilities, we talk about non-current and current liabilities, and some of the things that constitute current liabilities and non-current liabilities. We talk about the components, we talk about shareholder equity. We talked about some of the things that is contained in shareholder equity. We talk about profit and loss. Mr. Innocent was able to speak to the details of the profit and loss yesterday. And we also talked about the structure of P&L, talk about the structure of P&L statements. So we closed yesterday's session with the cash flow, where we talk about the operating cash flow, investing cash flow, and we talk about financing cash flow. So, and yesterday we promised that we'll be starting with the double entry accounting principle, what we meant by double entry, and the TB, which is the trial balance. We talked about the financial statements, where we'll be looking at the balance sheets, the profit and loss, which is the income statements, and the cash flow. We've actually talked about all these things, but we just want to go deeper to the concept of uh, financial statements. So let's start with double entry principle today. Let's start with double entry principle. What is double entry? What does double entry principle refers, or what does it mean? So we say it's a fundamental concept in accounting that ensures every business transaction is recorded in two accounts, one as a debit and the other as a credit. What do we mean by that? So accounting gave us, like I said, accounting is a principle discipline, is a principle discipline. You cannot do anything without following the principle. So there are laid down principles that we follow in to ensure that our account is
attend class.
so to ensure that our account is properly stated and recorded. So the principle, the double entry principle, signifies that you have a debit on one hand and you have a credit on the other hand, right? That's the basic principle of accounting, that for every respective debit, it must have or has its corresponding credit. That's the flow. You cannot debit an entry without making the corresponding credit. When you debit, you credit. When you credit, you debit. That's the principle, right? So those days, people used to play with this what they call it, the wordings, to say debit the giver, the credit the receiver, or something like that. Debit the receiver and credit the giver. Yeah. So the concept is debit debit the receiver and credit the giver. That's the concept. So let me also use this that we all know before now, which is our banking. Yeah. The way when you receive money into your bank, it is seen, or it is understand to be a credit, right? When you receive money into your account, you say, I just got credited. Yeah. Just got credited. And when you move out money from your account, or when you send money to someone, it is understandable, it is understand to be debit. But that's bank. But in accounting, it is reverse the case. So when you receive money into your account, right? When you receive money into your account, it is debit, right? Then when you give out money, it is credit. Do we understand that part? Because we need to understand this block, this basic, before we continue. Right? We need to understand this basic before we continue. When we say debit and credit, it's very, very important. The moment we understand the concept of debit and credit, every other things would flow accordingly. Right? So when I said, when you receive money into your account, you say, I've got credited. But in accounting terminologies, when you receive money into your account, it is debit. And when you give out money, it is credit. Please, let's get that concept, please. So there's another thing called dealer. Okay, yeah, I'll come back to this concept of dealer. Okay, so Now let's continue with our, then I'll come back to some of this. I just note that so that I won't forget to talk about it. So the total debit must always equal. The total debit must always equal to the total credit. What do they mean by this? Meaning, if you have a credit, or let me say a debit of 1,000, sorry, if you have a debit of 1,000 or 100 naira, let me just say, you must have a corresponding credit. That's what it means. So that at the end of the day, this credit will always be negative. So at the end of the day, when you say this plus this, it will be zero. This is this is the principle. And this is what, for more than decades now, or century, this is the principle that every accountant has followed. So for every debit, there must be a corresponding credit. So this is what it means in just in short. So every transaction must have an equal amount on debit and credit with opposite sign, right? Did you see when they say up and credit with opposite sign? That's what I just did here by indicating the negative sign here, so that everything balances. Now, this principle forms the backbone of accounting system and ensure accuracy in financial record. It is. That's what I've explained before. Now, this statement is affirming that position. So, key points of the double entry principle, like the key points you need to take in consideration is, first one is twofold effect. We've also talked about it, but we just explain it in details. Every transaction impact at least two accounts. Every transaction impact at least two accounts. What do we mean by this? Please, 1 minute. Yes. Okay. The twofold effect, I repeat, the twofold effect. Every transaction impact at least two accounts. For example, if cash is used to buy goods, cash decrease while inventory increases. I'll come back to this definition of decrease and increase because you may not really get that concept of. I will still come back to it. I'll come back to it. Sorry. Okay. So, I'll come back to this, for example, the example part. I'll come back to it. So now let's go to the second part, which says debit and credit. Debit represents an increase in assets or expense and a decrease in liability or equity. Remember, we talk about the accounting principles that says, or the equation that says assets equal to equity plus liability. Right? Remember, we talked about that principle of assets equal to equity plus liability. And then, so when we said asset, so the expanding equation of this, because I used to do this often, I'll just say expanding equation. I'll say assets plus expenses. Let me just say expenses plus drawing, which could be an old ways, is equal to equity plus, plus liability. Sorry, I'm not writing this down there. Plus revenue. So this is our expanding equation. I think it's just 6. Okay. So what you should understand by this part is that for for those things by this side, by this hand side, for this asset expenses drawing, they are all debit accounts. Are we together? They are all what? They are all debit account. Let me move this part. Okay. So all these parts are debit account. Let me just symbolize it with color. And all these are credit accounts. So I will also with this to debit account. So take this as something you like, something you do your daily routine. Understand this concept of assets plus expenses plus drawing. They are all debit accounts. Why we said equity plus liability and revenue, they are all credit accounts. Take it like that. Yeah, they are credit. Its concept is the principle. So what do they mean? They are all debit accounts. What do they mean? They are all credit accounts. Meaning that for any time you are debiting an asset, you are increasing it. So when you debit this account, these three accounts here, you are increasing it. You are increasing the account. And if you indeed credit this account, if you credit this account, you are increasing the account. I know you guys will be like, what is this guy saying now? Let me repeat. We said asset, expenses, and drawing, they are debit accounts naturally. They are debit accounts. Why we say equity, liability, and revenue, they are credit accounts by nature. They're like natural order, they are credit accounts. But if you are not crediting a debit account, like an account that is a debit account in nature, if you are crediting it, you are decreasing it. You are decreasing it. When you credit it, you are decreasing it. But when you debit it, because the natural, what do you call it, a natural debit account, you are increasing it. Let's take, for example, let me do something. Okay, let me just go ahead here. Let's take, for example, you have an asset, let's say asset 100 something. It has maybe 10 naira. Now, and when we say we are debiting it, we say we are increasing it. So, and debit is always positive. You get debit is always positive. So, we want to add 10 naira to it. If we add 10 naira to it, it will mean that this account, okay, let me just do something. It will mean this account will turn to 20, right? It will mean this account will turn to 20. We're assuming this is an asset and it's a debit account that has 10 by value. It has 10 value. Now, you want to debit it again, which means you want to increase the asset. Let's assume you bought a laptop, right? You have a laptop, which is an asset to you. If you're not buying another laptop, what are you doing? You are increasing it. You understand? When you debit an asset, you are increasing it. But now, let's take a credit now. If you take a credit of, let's say, 20, what happens to this thing? You see it turns to zero. Let me go back. Maybe you did not see what I've just done. We say we have a laptop, let's say Dell. Let me change this thing to Dell laptop. And we say this is HP laptop. Let's now say these two laptops got stolen and you want to write off. I don't want to go to some accounting stuff. I just want to, let's assume you want to credit it. Let's just put it as you want to credit it. So when you want to credit this account with, let's say, 20, what happens? If I put 20 here now, a credit, I remember I said credits are negative. So if I put 20 here now, what happens? This, all the amounts in that account turns to zero because I am decreasing the what? I'm decreasing the assets by crediting it. I'm decreasing the assets by debiting it. Simple as that. So when I said all these accounts are natural debits, meaning that whenever you are crediting a natural account that's a debit, you are decreasing it. So that's why I say let this thing be at the tip of your finger. Know for real that assets, expenses, drawing, equity, liability, revenue. So, I was talking about something dealer. Remember I said something dealer. And the D stand for what? Dividend. People call it dividends. And E stands for expenses. And EA stands for assets. Then L stands for liability. Don't mind my spelling for now. Just and the R stands for what? Revenue. Sorry, sorry. I needed to bring it some. Sorry. Just 1 minute, sorry. Sorry. Someone needed to join this call, but I did not send it to the person. Okay. So, like I said something called dealer. Sorry for that interruption. I said something is dealer. Dealer. Just cram this acronym. Dealer. Dealer. You know, the word Dealer rather. Dealer. 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 And the D stands for dividend. So you can always change this expanding equation to, instead of drawing to dividend. You know, I said it's an old school. You can say dividend. You can say dividend. Yeah. So the D stands for dividend, while the E stands for expenses, the A stands for assets, the L stands for liability, the E stands for expenses. So I've not done this. Wait, I missed something. Equity rather. Equity. Yes. The D stands for dividend, the E stands for expenses, the A stands for assets, the L stands for liability, the what they call it, the E stands for equity, and the R stands for revenue. You can see there are 6. So the first three word, here now, the first three are debit accounts. The first three are debit accounts. While the last 3 are credit accounts. So if you have this acronym on top of at the top of your finger, you quickly remember, right? That the first 3, which is dealer, DEA, which is dividend, expenses, and asset, these 3 are what? They are debits. While the LER rather are credits, which is liability, equity, revenue. So they are in natural order. So when you have this, we'll get to a place where you understand. So this debit, credit, increase, reduce. It's very confusing. It's always very confusing. But the moment you get it, that's all. It will stick to you forever. So imagine you are aspiring to be an SAP consultant now, and the users are doing their day-to-day activities is accounting. So if you, as a consultant, does not understand what they know, then you have a problem. So you must know what they know. So if a user is coming to me now with an issue or with a problem, I need to know what he knows before I can provide solution. Right? If someone comes to a doctor for diagnosis, the doctor will ask questions. Even though the doctor is a professional, the doctor will ask questions. What is wrong with you? Okay, I'm having headache. Oh, what headache? How is the headache? Is it often? Is it that? They will ask you questions before they can propose what you do as solution. They will ask, okay, you take this malaria, you take this, that, before they will not tell you what to do. So you need to have a listening ear as a consultant. You need to have a listening ear to the users. But remember, the users are very vast too. When it comes to the accounting, what they are lacking is the system application. What they are lacking is system usage. So you must know what they know. And that's why it's essential for you for you that are aspiring to become an SAP FI consultant to know a little bit of financial accounting. Now, imagine a user comes to you and he says, I'm trying to credit, he's trying to pass an entry, a very wrong entry. Let's say he's trying to, let me look for an example. So he's trying to credit an expense account. I remember I told you that every expense account is a debit. Remember I said on this right-hand part now, the expenditure, all expenses are what debit in nature. So meaning that for every entity that should go there, it should be debit. But there are some instances whereby it is credited. If I'm an auditor and I come to you, let me tell you again, this is the trick. This part is the trick. Is the trick. If you understand the concept, this equation, this long equation, and you understand what asset means in natural order, that is a debit account, expenses is a debit account, equity is a credit account, liability is a credit account, revenue is a credit account. When you have these basics in your head and you understand what debit and credit are, for every debit there must be a corresponding credit. This concept will take you far. Because when someone comes to you or they are showing you that they are having issues, maybe in the system, we have structured the system that if you are crediting this account, you should not allow it. And the user now comes that I'm trying to post this entry. I've been unable to post it for 3 days. They give you what? Then you look at it. What are you trying to do? So because you have understand the concept of debit credits and the rule of saying when you debit, you increase, when you credit, you reduce, then you know. So imagine the user is trying to credit an expense account. Then you ask the user, what are you trying to do? And he say, I'm trying to post and then you ask, but you are debiting this, you are crediting this expense account. Are you trying to reduce the expense? Was it that the first transaction that happens was incorrect, so you want to reverse? So you want to reverse if you see a credit, because as an auditor, when you look at an expense account and you are seeing credit, 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 what it means is that they are trying to reduce their expenditure. Remember, I said all expenses are debit account. So whenever you see a credit in the account, it means that what? They are reducing it. They are not increasing it. So an auditor will frown at it. Why are you reducing it? Was it that the first transaction that got posted was mostly wrong and all those things? So this is the concept. Same thing goes to equity, liability, and revenue. All equity accounts, credit accounts in natural order, and all liability accounts, credit account too, and revenue account, credit account. This is the rule. We don't need to be questioning, oh, why is it credit? Why is it liability? This is the rule. Let's take the rule as what we need to know, right? I think I've been able to, because I stress much on this part, just because I want you guys to get this part correctly. I think I've been able to do justice to this thing. I need to ask question at this point to know whether we really got what we are saying. Can anyone just ask question? Hello? Do we get what the explanation we just gave now? Did you?
Yes, sir. But then I
Yes,
wanted
sir.
to ask that
Yeah.
how do you, because you explained that under this debit account, when you get more laptop, you are debiting an asset,
I'm not
right?
sure
And
you're
then you
loud.
said,
Or could it be my device?
can you hear me now? Is
Yeah, I can hear you, but faintly.
it
I don't know
better now?
if it's my device. But go ahead. Go ahead.
Okay. You explained that you debit an asset. For instance, the example you gave concerning the laptop, that when you get a laptop, you debit it, which is under assets. And then you later said that if you credit it, you are that if you credit it, it's going to be zero. So I wanted to understand what you mean by crediting the debit account.
Hello?
Can you hear me
Hello?
now?
Can you hear me?
Yes, sir.
Okay, please repeat yourself again. I couldn't hear you properly. I had to join. I had to use another device to join so I can hear you. Please go ahead.
Okay. You said getting a laptop is us debiting an asset account. So you also
Correct.
said that if we because you put 10, and if we should credit it, that it will be zero. So I wanted to understand what you mean by crediting the debit account.
Okay. Okay. I understand. I get what you just said now. Okay, so what I meant by that scenario, it's not as if that's how you debit and credit an asset. That's not the proper way of treating an asset, actually. It's just an example. It's just an example. An example in the context of what we're discussing with regards to uh, we debiting an asset and crediting it. So the illustration we were trying to give at that point was showing the increment and the decrement as per the rule that states that all assets are debit accounts. All assets are debit accounts. They are debit. That's it. They are debit accounts. But when you credit an asset, you are reducing an asset. However, you cannot even credit an asset directly. You don't credit an asset directly. It's just an illustration to show you the ups and downs, which is the increase and decrease on the decrement rather, with regards to uh, assets. That's all. The rule as per how you treat assets is a different rule. I will get to that place where I will explain how to treat an asset properly. But the concept I'm trying to give is when I said 10, 10, which means you have a debit 10, which is a positive, debit are positive, they are positive indicator. you have debit which you so you now have 20 value of an asset. So now imagine you want to decrease it, whether you have overshot the acquisition value of the asset or you want to write off the asset. So you want to write off the asset or you want to decrease the asset, you have to pass a credit to the asset, right? So when you pass a credit, what you are doing is that you want to nil off or you want to reduce the asset value. Do you understand? You want to reduce the asset value. That's what credit means, right? When you credit an asset, you are reducing it. But if you now go to the other side now, which is the expense side now, when you credit an expenditure, you are increasing it. Again, let me repeat. When you because since let me repeat this part. Since assets, expenses, and dividends are naturally they are what? They are naturally assets, expenses, and dividends, since their natural order is debit accounts, when you debit them, they increase. It's by the natural order, they increase. They are debit accounts. So whenever you debit a debit account or whenever you debit an account that is a debit in nature, they will increase. But when you credit them, they will decrease. Now, if you go to the other side, which is this side, which is credit account, if you credit a liability or you credit a revenue account, it will increase. When you credit this account, it increases. But when you debit it, you are reducing it. Does that sound well to you? Did you understand these concepts?
Yes, sir.
Mohammed, please, can you explain this debit and credit accounts, assets, expenses, dividends, equity, liability, revenue to me? Can you explain it to me as you understand it? As you
Yeah.
understand it.
Good morning, everyone.
Yeah, good.
So basically, what I understand from this concept and from the little knowledge I had in the accounting basics. So debit generally means left hand side, and then credit means right hand side. So from the accounting equation, the fundamental accounting equation, that's asset equal to equity plus liability. So on the left hand side we have debit, and on the right hand side we have credit. So everything that is left of the equation is debit, and everything that's on the right of the equation is credit. So on the debit side, that's the assets, including the dividend expense. Whenever we want to increase an asset or expense or dividend, we debit the account. That means we've added value to it. And whenever we want to decrease, we credit the account. So on the alternative sides, that's the credit account. Whenever we want to increase equity, liability, or revenue, we're going to credit the account. And whenever we want to decrease it, we debit the account.
Good. Hello?
Yeah,
Hello?
I can hear you.
Yeah, good. You've done some justice to the question asked. Gania, please, can you also explain what you understand by this concept? So I guess Gania is not responding. Kudirat, do you understand? Can you just explain this concept? Okay, Gania is back. Okay, Gania, go ahead first.
Good morning, sir. Hello, good morning, sir. Can you hear me, sir?
Good morning, I can hear you. I can hear you.
Okay, so basically what this is telling us is that it's explaining the double entry principle, which states that for every debit entry, there has to be a corresponding credit entry. So the debit and the credits, so we have to, like, anything we have on the debit side has to be corresponding with whatever we have on the credit side. So the debit, and according to Mr. Mohammed, he said that the equation that gave us that assets is equals to equity and liability. It means that whatever it's in our asset has to be equal to the equity, and equity plus a liability. which is the same thing as the expenses and dividend. So our debit has to be corresponding with our credits. Basically, that's what I know it is, sir. Can you hear me, sir? Hello?
Yes, I can hear you. But do you also understand the concept around decrements and increments? Like when you debit an asset or expenses, dividends, equity, so what happen? So when you debit a liability, what happen?
When you debit a liability, that means you are increasing the liability.
So look at the concept again. So since asset and expenses and dividends are debit accounts naturally, when you debit these accounts that are naturally debit accounts, you increase it. But when you credit it, you decrease it. Do you understand? So accounts that are like equity, liability, and revenue, which are credit accounts by in natural order, if you credit those accounts, you are increasing it. And when you debit the account, you are decreasing it. Now, I'll repeat my question. If you debit an expense account, are you increasing it or you are decreasing it?
Increasing.
You are increasing it, sir.
So when you credit a revenue account, what happens?
I've increased it.
Increasing. Yes, sir.
Increased it as well.
Okay. So when you debit an equity account, what happens?
You have decreased it.
So when you
Decreasing.
debit,
Yes, sir.
yeah, when you debit an asset, what happens?
You increase
It
it.
increases.
So when you now credit an expense account, what happens?
You decrease it.
Decreases.
Okay, when you credit
Instead of
the account, what happens?
sir, I can't hear you, sir. Come again.
When you credit an equity account, what happens?
It increases.
Increasing. It's increasing.
When you debit an equity account, what happens?
Decreases. It decreases.
So that's I was able to confirm that from you guys. You guys have understood it. So when you debit an equity account, it decreases. When you debit a liability account, it decreases. When you debit a revenue account, it decreases. But when you credit an equity account, it increases. When you credit a liability account, it increases. When you credit a revenue account, it increases. When you credit a dividend account, it decreases. When you credit an expense account, you are decreasing it. When you credit an asset related account, you are decreasing it. But you debit now, when you debit an asset, expense, and dividend, you are increasing them. That's the logic around it. Just keep this in mind. You will still find it worthy to use. Many even senior consultants, many senior accountants miss this thing sometimes. It's when they now try to sit down and they will, oh, okay, we are correct. So get this logic and you would see you see how good. So let's continue. We have spent longer time on this debit, but it's very good that we spent that much time there so that you get to understand the concept. So let's go to example of a double entry principle. We have explained what double entry is. Now we'll go to the principle, the double entry principle now. So the first example says buying inventory with a cash. A business buys inventory worth of 100,000 with cash. What happens? Since we say we are practicing a double entry principle. So now a company borrows, okay, no, we are not there yet. A business buys inventory worth of 100,000. So Ghanaian went to market to buy fabrics for our tailoring business, right? So when he buys this material, the fabrics, those fabrics are stock, or call them inventory, and you have to post them to an account, right? So what happens when you buy those inventory? What happens is that you debit the inventory account with 100,000, then you credit your cash account with 100,000. Do we get that? Do we get that?
Sir, please, can you make an illustration?
Hello?
Hello, sir.
Yeah. I can hear you. Go ahead.
Sir, I said, can you make an illustration?
Again, okay, fine. I said we want to now do example of the double entry principle that we have learned, right? And now we are saying Ghanaian went to the market to buy some fabrics, and those fabrics, she's using those fabrics to produce galamia or gown for ladies and men. Yeah. So she has some cash in her hand. She has 100,000 in her hand, and she has gone to the market with that 100,000. That 100,000, she has it in her, whether bank or cash anyway, but in this case, it's cash. So she has gone to the market to buy. So she meets Madam Kudirat, who is the supplier now of the fabrics. So she gave 100,000 to Kudirat, and Kudirat now gives her the fabrics. So Ghanaian went back to her shop, because we have said the recording is very important. Documenting all whatever you are doing is very important. So she now wants to document it. And that is what this thing is showing us. This thing is telling us that you will debit your inventory account, or you call it fabric. You can have an account, you name it as fabric account, or you call it a Gumi account, or you call it lace account. Now, but not to be having, you can call it inventory based on what the note is telling us. The note saying inventory. So you have not, the what they call is telling us that you should debit your inventory account and credit your cash account. Do we get that?
Yes, sir.
Again, you remember when we talked about assets? And we said assets, as the component or the structure of an asset, is current assets and non-current assets. I'm sure we all remember that. And we said under your current assets, we have cash and its equivalent. So cash is what, Mohammed?
Cash is asset.
God bless you. So inventory, where does inventory fall to, Ghania? Is it under an asset? Is it under liability? Is it under equity? Or what have you? Where does it fall to? Is Ghana on this call?
So the network is breaking. I can't really hear you.
Okay,
Though.
can you hear me now? I
Yes,
said,
sir.
if cash is an asset, as stated by Mohammed,
Yes, sir. Sir?
Inventory is what? Where does it fall to? Is it liability? If cash account is an asset under current assets, inventory is it a liability?
Inventory is also an asset, sir.
Good, that's correct. So inventory also falls under asset, which is current assets, and your cash account is also under current assets. So now, when you debit your inventory, which is an asset, what happens? Kudrat,
When you debit an asset, it
it
increases.
increases. Okay,
It
good.
increases.
So, Kudrat, when you credit a cash account, which is an asset, what happened?
It increases.
Eh?
Sir, please repeat what you said. The network was breaking.
I said, when you credit a cash account that is an asset under current, when you credit
It decreases. It
it
decreases.
decreases. Good. That's correct. That's correct. So I'm sure we now understood the concept now. Now let's go to example 2. Taking a loan. So a company borrows 500,000 from a bank. Now, if you borrow 500,000 from the bank and the bank has agreed to give you 500,000, what happens? Kudirat, what happens?
There is increase in liability.
Mm-hmm. Yeah. I think Kudirat is solved it. Cool. Mohammed,
Yes,
tell
sir.
me, explain to me why when you credit, when you borrow money from the bank and they give you 500,000, you have gone to the bank to borrow 500,000 naira, right? What would you record?
Yes, sir.
Since you have said recording is very important, how would you record it in your book?
Okay. So when someone goes to the bank to borrow money, there are two accounts involved. One is the liability, which is the bank, and then the other is the cash, which is an asset. So since we've gotten more cash as a result of borrowing, the cash would increase, which means which translates to a debit of the cash account, and then the loan, which is a liability, will increase, which is a credit since it's on the other side. So the credit, what's it called? The liability, that's the loan account will increase. That's a credit. So whenever you have a debit, you must have a corresponding credit. So debit cash and then credit to liability.
So you were able to explain the concept, but I think I will assume there are some slip of tongue in your explanation. So a loan account is a liability you have to pay back, right? Your loan account is a liability. And since we have liability as a credit account and you need to credit it again, what happens is that you are increasing it. Did you get that? Liability is
Yes.
a credit account naturally. So when you get money from the bank, remember we're talking about the concept of debit credit. When we say debit the what and credit the what, Gania, when we say debit the giver, credit the receiver, is that correct?
Sir, come again.
So there is a concept that we often use as account person. We say debit the giver and credit the receiver. Is that correct?
No, sir. Debit the receiver and credit the giver.
Hello?
Can you hear me, sir?
Yes, I can hear you. Hello?
Hello, sir.
Go ahead.
I said it's not correct, sir.
Okay, what's the correct position?
We debit the receiver and credit the giver, sir.
Good. I purposely did that because I want you to either agree or not agree. That's correct. So you debit the receiver and you credit the giver. The receiver now, you debit it. Please understand this concept. They are the fundamentals. The moment you have them at the tip of your finger, you will never make mistake again. So you debit the receiver and credit the giver. The giver now, you credit the giver now should be credited. Just get it. Find a way of putting it in your head. Do you understand? Debit the receiver, credit the giver. Now, in this case, now you have gone to the bank and the bank has given you 500,000 naira, right? So you have collected 500,000 from the bank and now you want to record it in your books. 500,000 has come to you as a receiver now. What do? You debit your bank, right? You debit your bank. You have received now. It's a debit, right? Because you have received. Because we said debit the receiver. It's a debit. So you have to debit your bank. Now, and you remember we also said because of the double entry principle, if you debit an account, you have to credit the other leg, corresponding leg. And now what's the corresponding leg? Is the loan. The loan you have received because you will need to pay back. And because you have to debit an account and credit the other side, so you have to credit a loan account, right? This is the entries. Now, we are not talking about increment and decrement. Once this increase and decrease is not really something that you should worry about because I'm not saying we would face most of these things. People don't. It's not really something. It's just for you to know anyway. So when you debit a cash account, which is an asset, you increase it. And when you credit a loan account, which is a liability by nature, you are increasing it too. So there's a double increment there. So now we go to example 3. I'm sure you guys already understand this because we have dwelled much on this double entry, and which is very important actually, but you should understand it. So receiving payment from a customer now. So you want to receive an amount from customer. So customers has paid you 50,000 for goods sold on credit, right? So you debit your cash account because you are receiving money now. You debit your cash account and you credit account receivable account. Now, remember, cash account is an asset. Account receivable too is an asset. Account receivable is also an asset. So when you credit an asset, you decrease it. That's why you say decrease in amount owed by the customer. I will not do much on that. I will just continue. So this is just benefit of the double entry principle, accuracy, fraud detection, comprehensive record. This is theory. You can always read about it. Now let's go to journal entry, which we have started actually, but just to talk more of it. Now, journal entry, when you see journal entry, JE, journal entry, is an accounting transaction posted in either GL or subledgers. I will explain what subledgers is and what GLs is. So we said when you posted transaction in a GL or subledger, we call it journal entries. In finance system, JEs, which is journal entries, can be automated, semi-automated, and manually automated, meaning manual journal entry. Manual journal entry, that's what it means. Documents that may require human intervention, manual journals are considered a high-risk area within the field of financial accounting. It's mainly due to interventions involving direct entries to general ledger, potentially impacting the financial statement of an entries. For example, what do we mean? Imagine a bookkeeper have posted an entry, a wrong entry, just like we were considering which one should be a debit, which one should be a credit. And now you are the officer now, you are the payable officer that are supposed to post this entry. You have posted this entry wrongly, and your line manager has now gone into the system to now see that, Mohammed, why are you crediting this account and debiting the other leg? What are you doing? They say, you have done it wrongly. So the person will now need to post a journals. Journals are for correction sometimes, oftentimes anyway, they are for correction. 90% of journals are correction entries. So you come and pass a correct entry now to do what? To adjust or to correct what the earlier person has passed into the system, right? That's just what the explanation of this part is. Now, example, credit your Zenith Bank account with 500 and debit transport local. What is this person trying to do here? When you credit your bank, and debit transport local, what are you trying to do? Gania, tell me what we are trying to do. Okay, Kudrat, Tell me what we are trying to do. Let's open this call. Okay. Mohammed,
Yes, sir.
can you tell me what we are trying to do here? When you credit a bank and debit a transport GL, you credit a bank GL and debit a transport GL. What are you trying to do?
Basically, you are withdrawing money for your bank to pay for transport.
Correct. Correct. So you are reducing the money in your bank because you want to pay for transport. And when you credit that bank account, so basically, don't let me do debit credit again. I think that's correct. That's correct. So now look at below. Balance before posting. So you see this account here, these are GLs. You see 41474, they are called GL accounts. And 1500, stock raw material, 600, transport local. And now we give description, the GL account, the debit and credit. So you can see in the bank account, we have 600. In the stock raw material, we have 60. And transport local, we have 50. Let's take this as a trial balance, but we'll get there. So you see balance before posting and balance after posting. Now, you see this Zenith Bank account, right? Before was 600. Now it has turned to 100. Why? Because you have drawn money from the account. You have drawn 500 from this account, right? And if you draw 500 from this account, what happens? You credit the bank, right? And when you credit, we say credit is negative. So what happens? It reduces to 100, right? Now you get to understand the concept of reduce, increase, reduce, increase. So when we said a bank is an asset, right? And we are crediting it, we are reducing it. So we have reduced it of 500 and now we have 100, right? So now transport is an expense. You have incurred an expense, which is transport. You have used both, right? So you have incurred some expenditure and you need to pay. So you are paying a boat driver now the amount of 500. But before, we have 50 in this account, 50 naira in this account. The moment you put 500, if you do 500 into an expense account, remember an expense account is also a debit account. So when you do a debit to the account, which is this debit to transport local, what happened? It's increased, right? However, before now, transport was 50. But now look at what it has done to. It has done to what? It has increased. Now you would have understand what we are explaining in the past concerning increase and decrease, right? Don't let us dwell much. Let's continue. So I will ask question now. Find incorrect journal entries. Yeah. Is Kudrat on this call? Just confirm yes.
Yes, sir.
Okay. Is Ganya on this call? Confirm yes.
Yes, sir.
Okay.
But
I'm sure
the
Mohammed is also.
network is breaking. So,
You should find a good network. So I'll ask Mohammed first. Question E. This question E. Debit and credit. Is this a correct journal?
I would say no,
Why is it not a correct journal?
because you can only credit revenue, you cannot debit it.
Okay. So Mohammed choose no. Okay. Gania, I'll come back to all these things. I just want to note who has answered this one. Gania, question
yes,
D.
sir.
Is this a correct journal?
Debit inventory. Right. Sorry, I'm coming, sir.
While you are coming, Kudirat, number A, is this a correct journal?
No, sir.
No. Okay.
Yes, sir, it's correct.
Okay. Kudirat confirmed this is wrong. Then Gania confirmed this is correct. Okay. There's a correct check mark. Okay, anyways, not to waste our time, I'll just pick one. Okay, now let's look at what we have answered. So Mohammed answered that question E, that it is not correct. Yes, he is correct. Mohammed is correct. The journal entry on this is not correct because the rule states that for every debit, there should be a corresponding credit, right? Another corresponding credit cannot be on the same account. If not, you have not done anything, right? So you can see revenue, and debit credit of the same amount. It's wrong. It's wrong. You have done a wrong entry. So Mohammed is correct. Now, debit inventory, and credit amounts payable vendor. This is correct because let's assume you bought lace, one inventory. You bought Ankara, another inventory. So, and it's 200, 300, making it 500 with another 500, which is a credit. So this should tally because this credit should be what? It should be negative. And I don't know if you add them up,
Yes.
it will be zero. Look at it, it's zero, yes, sum, zero. So this is correct. Now, let's go to what Kudira says. Debit, credit, bank accounts, accounts receivable, right? We debit our bank account with 50 and we credit our account receivable with what? With 50. Now, the amount is correct. The bank, the GLs are different, which is bank and account receivable. So we are crediting account receivable. So this is correct. This is correct. So Kudirat is wrong. So, but Kudirat, why did you choose wrong? Let's hear from your perspective.
I said it's wrong because I believe we credit bank account and debit account receivable.
Now, yeah, you said something which is good, but let's make clarity to it. You can always credit a bank account or you debit a bank account. You can credit or you can debit. Reason being that in your own bank now, you get credit and debit inside. So it doesn't stop any bank, any other bank to do debit and credit. So meaning that you will receive money as either profit or sales on his goods or services, or you sell or you also buy. And when you buy, you credit. When you receive, you debit. So in this case now, the bank is receiving, and that's why they are debiting it. Now, where are they receiving from? They are receiving from an account receivable. Now, what is account receivable? An account receivable is an account that is holding all the customer is owing you. So account receivable is tied to the customer, while account payable is tied to the vendor or the supplier. Do we get that? So this illustration meaning that a customer has made payment. And when the customer make payment, you debit your bank account and you credit the customer. But in this case, account receivable. Do you get that? I'll
Yes, sir.
take that as yes. Yes, good. So now the second, which is B, debit, debit. This is
Please,
wrong.
can you come again? Network is really breaking here.
Hello?
Hello, sir.
Which part do you want me to come again? You mean the explanation of question A?
Yes, sir.
Okay, so
The explanation, yes, sir.
so this by order is correct. This is correct because we are debiting our bank and we are crediting account receivable. This illustration means that they are receiving money. Kudirat is receiving money into his bank account, right? A debit into his bank account. He's a receiver. We say debit the receiver and credit the giver. Now, she has received money into our bank of 15 naira. Oh, and we know, we said for every debit, there must be a corresponding credit. So you have to credit somewhere. Something is given. So what is that is given? A customer. In this context, account receivable. You understand? So account receivable is to the customer, while account payable is to the vendor or the supplier. I will explain further when we get somewhere. There's something downward that we used to explain the account receivable and account payable better. So it is correct. So this one is wrong. I'm saying to debit. So the moment I even see to debit, I don't want to look at any other thing. This one is wrong. This one is wrong. It's debit. You cannot have two debit because it negates the principle of accounting, the double entry principle. Now this one is debit credit. I say, okay, let me take a look. Now we are debiting inventory, meaning that we are receiving some fabrics into our stock account, our inventory account. Okay. Now we are credit account payable, meaning that we are getting this thing from a vendor. You know, I say account payable is to the vendor. This is also correct. From here is correct. From here to this place is correct. Now I move to the last place, the amount. The amount is not the same. So it's wrong. So you cannot, sorry. The amount must also be equal. If not, there will be a balance of one and it will not go through. So this is wrong. Are we together? So this is practice questions, right? So, and I'm sure with this explanation, we'll be able to get what journal entry is, how to pass a journal entry, and etc. So let's go down. So let's talk about general ledger now. What is general ledger account? Who can say something about general ledger account? Okay, no one. Okay, let me confirm. So general ledger account. I need to round up this thing today. Okay, so general ledger account, GL account, is a unique account where a specific type of transaction legs get recorded in. Example of account, we said asset, liability, equity, revenue, or expense. They are all accounts, actually. They are all accounts. So, but GL account is a unique account where specific type of transaction take place. Now, if you see an example, we stated an example here. We said GL account, we say 147400. So we take 147400 as our main account, as our bank. And we take 1500 to be our stock raw material and 60 to be our transport local. So these are accounts. These are GL accounts. As you can see, these are GL accounts. We are using this number. They must be unique. They can't be double in the system. They are unique. They must be unique. GL accounts must be unique. That's why I say it's a unique account where specific transaction take place. So on this account now, you cannot have transport postings in this account. It must be bank account postings. On this one, you cannot have any other transport, local, whatever expenditure in this account. No, if it is there, it is wrong. That's why they say a GL account is a unique account where specific transaction take place. Now, for instance, if you post a debit 100 naira to expense account, it will mean that you increase your expense for 100 naira. This we have explained before. So subledger accounts. Though we talk about ledger and we have subledger. What are subledgers? That's what we want to explain. Subledger accounts or subsidiary ledger accounts are used to record detailed transaction data for specific business processes or sub-modules. the key advantage of using subledgers account is that they provide a more granular view of financial transactions, enabling better control analysis of individual transactions. What do we mean? All this theory may be bogus to you. The subledger, imagine you have, we said something that account payable is to the vendor or supplier. Imagine we now have 1,000 supplier and 1,000 customer. Do you think you want to display all these things on your trial balance or your GL? No. You have a GL, which are unique. But this customer vendor are subledgers. They are not ledger. They are not GLs themselves. They are subledgers, right? That's what we mean. So example of subledgers are accounts include customer, vendor, and fixed assets. So they are subledgers. Now, in SAP FI, all subledgers accounts are linked to a GL. You will need to link all the subledgers to a GL because in your GL account, like we said, GL account is a structure of unique identifier. So you cannot, if you take or treat all vendors as GLs, your GL will be too bogus. So you use a GL, one GL, you create one GL, and you link all the subledgers, all the customers and vendor, you link it to that account. Yeah, that's why they say customers, vendor, and fixed asset because they have children. So a GL, a customer, will be a subset of an account receivable. Are we together? A customer will be a subset of account receivable. Why? Why vendors will be subsets of what? Of an account payable. So for every vendor, they will be tied or linked to a GL called account payable. Now you can call it other name, you can call it but account payable. Let me leave it as that. Now you can see the story also said linked to a GL account referred to a reconciliation account. So that GL now is referred to as reconciliation account in SAP. I wish I can show you one. Not now. I will still get there. We'll get there. So, for instance, in the provided example, all third-party customer, do you hear that? All third-party customer, account receivable, trade debtors are linked to GL account 2300 da 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 da. The summary balance of the GL account represents the total of all customer accounts. Do you see that? The summary of all the customer or vendors will be shown in those reconciliation accounts, right? So that's that. So illustration, we have 147 da 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 da. Now this is a vendor 2020-30 is a vendor trade reconciliation account. What's this? So okay, now I remember. Okay. So this account now, all these are vendors. ABC Data Company Limited, ICRA Consulting Solution Limited, Macquarie Milk Dairy Limited. They are what? They are vendors. They are vendors. And they are tied. They will be tied to what? To this vendor reconciliation account. They will be tied to vendor reconciliation account. So this vendor, this one will be under your GL account. Why these ones will be what? Your subledgers. Subledgers. Yeah, they will be subledgers. Are we together?
No, sir.
You want to ask a question?
Yes, sir. Please, can you start again from the GL?
From the GL.
I don't understand.
Which one does what don't you understand? Tell me. So do you understand what GL is?
No, sir, you are too fast, so I didn't catch everything.
Really? Okay. So I'll recap now. So GLs, we said GLs are unique accounts. We said GLs are unique accounts that represent specific type of transaction or that show some specific type of transactions. So GLs, they are just So we refer to GLs as, okay, I want to see how I can explain to you so that at least you get it. Okay, if we say GL account is a unique account, right? Let's take it as when we were in secondary school. We have science class, we have social science, which is the commercial class, and we have the art class, right? So these are bifurcation, or these are classification of classes, so that we'll be able to distinct them, right? To say science, art, commercial, right? Now, take those classifications as GL, as GL. Take them as GL. Those classifications, science class, GL. Social science, which is the commercial class, GL. Art class, GL. Take them as that. Now, the students in the class, in the art class, take them as the sub-ledgers, right? Take them as sub-ledgers. So, the students in science all take them as sub-ledgers. If the principal is to refer to science class, he won't be saying Mohammed Bakori, Gania, Gania Shakira, and Kudirat, Ani Mashaun, or something like, just calling their names. You just say, imagine the principal will be mentioning names, and you will refer them as the science class are too troublesome, or the social science class are noisemakers, right? He has covered them up. He has referred them as science or as, right? So if you want to know the number of students in science class, they will just go to the roster. How many students do you have in science class? Okay, 30, that's all. Do you get that example? Let me bring it back to GL. So we say GL account is a unique account where specific type of transaction take place. Yes. Now, I will say what are GLs. We show example that GLs are like your bank account. Your bank is a GL. Your stock account is a GL. Your expense accounts are GLs. Or which ones are now sub-ledgers? We now say customers, vendor, fixed assets. These are the sub-ledgers in finance accounts. They are sub-ledgers in financial accounting, right? They are subset of a GL. And there's a place in SAP where you link your customers to your GLs, to the reconciliation GL. We call them those GL that you are linking the customer to a reconciliation GL. That's what we call them in SAP. Does that explain what your curiosity, or you still want further clarity on that?
I understand now. Thank you.
You said?
I understand now.
Okay, fine. Okay, thank you. See, I'm not expecting all of you guys to understand it outrightly on just one call. Yeah, it is over time. It's not just one day. In fact, there are some things you understand now, and after a while, you say, I do not understand again. And you need to go back to the video and listen to it again, or do further research before you can now put all of these things together and say, okay, this is the knowledge I should have, right? So now we'll go to chart of account. So when we say chart of account, chart of account is a list of accounts. Take it that way. Just say list of all accounts, right? That's what chart of account is. But based on the theory given to us, we said the chart of account is a structured template with all the GL accounts. I said, for me, my literal definition of chart of account is what? Chart of account. We mean list of all accounts. That's my literal understanding of it. List of all accounts. So when we say we have a bank GL, a customer reconciliation account, a vendor reconciliation, all of these are what? Are GLs under what? A chart of account. So you do a chart of account. So both template with all GL accounts, you see, is a structured template with all GL accounts, both balance sheets and P&L. Their description used by an organization entities provides a framework for organizing and classifying financial transactions based on standard policies, processes that follow particular organization, right? So this is a structure of a chart of account, right? We have component, we have balance sheet and P&L here. So you have balance sheets here, you have P&L here. So you have components, we have assets, and remember, everything we are doing still fallbacks. Everything we are doing fallbacks to the first equation, which says asset equal to equity plus liability. Are we together? So you see asset, you see liability, then forget this operating expenditure side, but we'll still talk about it. And we say other assets, we have current assets, we have non-current assets. Now, under current asset, we said we have bank, we have trade debtors, which is account receivable. Trade debtor is also called account receivable. You get. Now we have prepaid expenses. I've explained this yesterday, what prepaid expenses means. And we have other current assets. Now, under non-current assets, we explained what are non-current assets yesterday. Fixed assets, assets under construction, intangibles, other non-current assets. So these are GLs. You can see these are GLs. And this is the description of the GLs. Now we have current liability as well, just like we explained yesterday. We have non-current liability. We have this. So these are just a structure of a chart of accounts, right? We say it's a list of what? Of accounts, right? We say it's a structured template with GL accounts, right? And that's explain what chart of accounts is. Now, we'll talk about trial balance. Trial balance. Trial balance. Is it trial balance? Now, trial balance. A trial balance is like a summary list that show all the accounts in a business and their balances at a specific time. Now, the difference between a trial balance and a chart of account is what we are trying to explain now. You see, they said, look, listen to the theory. Say a TB is like a summary list that shows all accounts in a business, their balances at a specific time. Note them, specific time, balances, right? So, and that's why, because when you are running reports on your TB, you could run a TB balance report every month. You could run yearly, you could run quarterly. That's the specific time now. And it will show you the balances. Now, the balances that it will show you both debit and credit. Because of the principle of account that says for every debit, there's corresponding credit, meaning that when you are debiting an account here, there's somewhere you're also crediting. At the end of the day, this account and this will equals to zero. The moment your TB is not zero, meaning that something is wrong. But if you are using a system like ERP system, your TB will balance because there's no way you will post an entry without the system, because you have structured the system to allow to follow the double entry principle. So as you can see now, this account is balanced. You can see a summary of all these accounts is 348. If I click enter, you see 348, 348. You can see. So you can see it's balanced. But if I say this to be zero, so this balances. Now let's go to financial statement. What is financial statement? So a financial statement is the formal record of a company, financial activities and performance over a specific period. Now, in Nigeria, we're expected to submit our financials to respective agencies like IFRS, like CAC, and the other agency that you're supposed to submit your financial statement to every year, right? So this is what the government wants, so that they will validate what you are doing as a company. Now, financial is the formal record of a company. You can see a formal record of a company financial activities and performance over a specific period. It's like a report card. You understand? It's like a report card that tells the business owner, investors, or stakeholder, or government how the business is doing financially. So key types of financial statements. We said balance sheet, profit and loss, and cash flow. We've talked about what balance sheet is. We've talked about profit and loss. We talk about cash flow, but we'll just reinstate again today. Now, balance sheet shows what a business owns, right? Because your balance sheet comprises of what? Your asset, liability, and equity. So it will show what the business owns, which is asset, which is asset, and what it owes as liability. So those loans you have collected are liabilities, right? Now, and the owner's stake. It will also show the owner's stake, which is equity now, at a specific point in time. So think of a balance sheet as a snapshot of the company financial health, right? So two, profit and loss. We said profit and loss yesterday when we were explaining, we said it's simply your profit, the difference between your profit and loss. So income statement, it's also called income statement. We said it summarizes the company revenue, expenses, And whether it made a profit or loss during a specific period, you can say everything is about period, time, because your financials is in relation to time, specific period and time, right? So your profit and loss is simply your profit and loss account is simply your profit and expense account. You call it loss account, simple as that. Now, cash flow statement. Your cash flow statement tracks how cash moves in and out of a business, like how the money is moving left and right. The cash flow looks at it, right? It looks at how your money is moving left and right. Payment, sales, expenses. It shows if the business has enough cash to pay bills or reinvest. And this was explained yesterday by Mr. Innocent. So this is a diagrammatical presentation of how you get your financial statement. Remember, whatever you're doing at your journal entries is to ensure you get your financial statement, a report at the end of the day. So you see, we start with general ledger. So after your general ledger, from your general ledger, you derive your trial balance. After you post all your journals, debit, credit, debit, credit, debit, credit. The next thing is to run your TB, which is trial balance. Trial balance will now show you your debit leg and your credit leg, right? Then the next thing, from your trial balance, you can now begin to plot your balance sheet, plot your profit and loss, and your cash flow. And all these things, they have relation. We'll get there. So you can see. So from general ledger, you get to TB. Because general ledger is postings. You have to post entries. You have to keep records like debit, credit, debit, credit. You have to do that before you get to your TB, and before you can now get your balance sheet, profit and loss, and cash flow statement. Now let's look at an example of a balance sheet. So this is a balance sheet now. So balance sheet, like we rightly said, we said it contain your current assets and non-current assets, right? So let's look at the current asset. Current asset, we said cash falls under your current asset. We said account receivable also fall under your current asset. We said prepaid expenses falls under current asset. Inventory falls under current assets. So this is an example of a balance sheet. And most likely for most companies that you work with, everything, like I said, see, forget all these jargons here. You will see, for example, if you're looking at the balance sheets of, let's say, big companies like NLNG or NNPC or Dangote Group, you could see some other items in their current asset. You could see a lot of other things there. But everything, every summary in that place still fall back to what? Asset got to equity plus liability. Everything will still be constrained to be squeezed back. It will be squeezed back to what? Asset got to equity plus liability. That's just it. But we are expanding it because we want to have, we are bifurcating them, separating them so that we want to have fairer view or drill down of items or transactions. So cash, so we now come to this place where we have property and equipment, goodwill, and you see the total current asset. If you look at this, the total current asset is 79,000, and now the total asset, which is this plus these two, will give you 172. You can see. So the same thing goes to your current liability, which is account payable, accrued expenses. So it's just similar thing. We've explained this thing before. It's just for you to look at it again and understand what they are doing. And we'll talk about shareholder capital. So this is just a snapshot of your balance sheet. Now, income statement. Income statement is a structure of your revenue, cost of sales, which is cost of goods sold, operating expenses, other income, and other expenses and taxes. This was explained yesterday by Mr. Innocent. I'm sure. I don't know if you all have the video, but if you don't, I will share you the link so that you watch the video for yesterday and even of today too. So we have revenue. So these are things that constitute your income statement, your P&L. Revenue, cost of sales, operating expenses, other income, other expenses, and taxes. Remember, we said your income statement is what? Your profit and loss. Your profit and loss. So what's your profit now? It's not profit yet, but a revenue. What do you make as per sales? What have you made as per sales? And remember, we say your revenue account is what? Is a credit account. So that's why this is coming as a credit. You can see. This will show that, oh, this account is okay, it's balanced, right? Your cost of sales is a debit account because it falls under your expenses. Your cost of sales is a debit account because it falls under your expenses, right? It falls under your expenditure. And remember, he explained yesterday what cost of goods sold means. So that's why you're seeing it as a positive debit, right? Now, your gross profit now will be deduction of your revenue, which is equivalent against the cost of sales. That's what we're having, minus 24,000. That's gross profit. Now, operating expenses now, which is 2,000, operating expenditure, just like your transport, your accommodation, this falls under your operating expenditure, which are debit account as well. So you can see how these things are relating and speaking to each other. Operating expenditure, they are debit accounts, literally, and that's why it's coming as debit of 2,000. Now, operating income will now be what? This plus this, which will be minus 22. Because if you deduct 24,000, 2,000 from 24, it will give you negative of 22. Same goes to this place. And that's what, as you are seeing, you have 23, 24, 25. This is how you see your balance sheet, 23, 24, like that. Now, other income, since we say every income or revenue, forget if they call it income, they call it revenue, they call it sales, they are all credit accounts. They are still talking about income from, they are the same thing. So they are credit account, that's why I are seeing this as negative. Other expenses, since we say it's other expenses, they fall under expenditure. You can see everything, forget if they expand the name, the nomenclature, or what have you, everything still fall back to the first principle, which is asset equal to equity plus liability. Now, if you want to take it further, it will now fall back to what? Asset, which is dealer, dividends plus expenses plus asset equal to what? Equity, equal to what? Liability plus equity plus what? Plus revenue. I think we get that too. We can read through it. Like I said, I'm not expecting you to just get this thing at a glance or just today alone. You just have it that, okay, this, I get it. So then further, when you start doing the work or when you start practicing, the thing will start syncing to one another. Yeah. So, and this cash flow is a little bit complicated, right? It's a little bit complicated. If you don't have some other basic understanding of how cash flow is structured, you won't really get it. But most time you won't have problem with cash flow. The business will not be coming to ask you, oh, give us, but just leave cash flow as it is. But it's a little bit complicated. I could explain it, but I don't want to scatter everything that you have been learning from money. But over time, you would tend to understand it. So because here, from what you are seeing here, you see depreciation and amortization. What is depreciation? What is amortization? So the other time I was explaining that to treat an asset has a concept. There's a concept on how you treat an asset. And the concept is from IS, what have you. I can't remember the number now. So when you want to treat an asset, there is 3 legs that needs to be created, a 3GL that needs to be created, even as SAP. And even on accounts, proper account, you need to create 3GL. So you need to have a GL that will warehouse all the value, all the debit value, all the acquisition value now of the asset. The second leg is to have an accumulated depreciation account relating to that asset. Now, the third leg now is to have a depreciation expense account to that asset. Let's assume now, I'm just using this medium to explain what depreciation is. I'll explain it. So if you have a laptop as assets, and then you have accumulated depreciation of laptop. Let me see. Depreciation of what? HP laptop. I'll just say HP laptop. Then you need to have depreciation too. Depreciation expense of HP laptop. These 3 accounts is you need to have them. So let's assume this one is 1 series, let's say 1,000. So this one could also be maybe 1,001. And this one now could be 5 series. Now, what do we mean by this stuff if you want to treat an asset? It's small. You don't know everything once, but small. So now, if you want to treat this thing now, you debit, when you are debiting, all your debit comes to this account. All the debit, the acquisition value will come to this account. Now, when you want to depreciate, okay, let's illustrate one. If you want to acquire an asset, we'll get to this place. I don't want us to go front and back again. Let me just I'm just using this page to show you what depreciation means. So now, when you are depreciating an asset, so anytime you are doing anything, anytime you see depreciation, what they are trying to do is to reduce an asset. Anytime you see depreciation, what they are trying to do is to reduce an asset, right? So now, when you are depreciating an asset, what happens is that credit goes to what? A credit goes to the GL 10001, which is accumulated depreciation account. This is where credit goes. The credit is not going to this account directly. It's going to this account. And what a debit will now goes to what? To the depreciation expense for HP laptop. So this is just one entry. This is just one example. So the credit will not go into this account directly. It will rather go into this accumulated depreciation account. Now, this account and this one, they are under assets. That's not current assets. Non-current assets. They are going to non-current asset. These two. Now, this credit that is here is a contra. When I say contra, that is it's like a contrast to the GL that ends with Z, which is the HP laptop with the debit account. So this one will be the one. So when you are forming your balance sheet, these two will be on the same page. One will be a credit account, and the other will be a debit. So the credit account will be the one reflecting on the debit side to reduce it, because it will be on an asset. Remember, we said assets are debit accounts, and you want to ask question: if accumulated depreciation falls under your asset, why are we crediting it? We are not saying we cannot credit assets. We are not saying we cannot credit. We can credit any item under assets, just like your bank. Your bank is under asset. We credit it, right? Even your asset, when you want to write it off, you have to credit it. But you are not crediting directly. You are crediting through accumulated depreciation account, right? Same thing goes to your account receivable. Your account receivable also falls under your current account as current assets, right? So you can always credit your assets to reduce it. So in doing depreciation means that you are reducing the assets. Depreciation means that you want to reduce the assets. So when you are reducing it, you pass a credit to the assets. But in this case, when you are passing a credit, the credit is going to the accumulated depreciation GL, not the asset GL itself. But however, the accumulated depreciation is a contra account to the assets. This is a principle on how to treat an asset. And the second leg now will now go to your depreciation expense account, right? I think this should explain what this depreciation. Then amortization. Now, amortization also simply means reduction. Because what we mean amortization is that, for example, like I explained this thing yesterday, when you buy, when you subscribe to DSTV or GoTV, and you have not used up the service that GoTV is rendering to you, and you have paid for 1 year subscription. So the month you have not used up, you can, because your prepaid expense falls under your current assets. Your prepaid account rather falls under your current asset. And you will definitely have another leg that falls under your expense account. So when you are doing amortization, you are passing a journal to reduce the prepaid expense account. That's where amortization comes in. Don't worry, when we get to where we are in the system, we begin to show you how this thing works. Then we'll talk about other interest, tax, capital, account receivable, account payable. So these are the components. Let me just leave all this. These are components of cash flow. You can read through it, and you can see these are calculations. That's why I say it's complicated. But this is Excel. I'm using Excel to plot this. So, but what I sent you is a PDF. So you may not really see how these are added up. But if you still want this Excel, I can always share this Excel to you after the class. So, because there are some rules that guide this cash flow, right? So see the key here now. Your net income, for example, I'm treating this one now. I'm using this one as example, 2023. Your net income is 15,000. Your depreciation and amortization is 1,000. Other interest, 7,000, already included in your net income. So no adjustment is needed. Right? So when you're formulating it, you will not add up. If you come to this place now, you will not add up your 7,000 to it because it's already included in your net income. So that's why I say it's a little bit complicated and you may not really understand it on a go, even if I explain it to you. But just leave this cash flow is not something that you should really worry. It's just we just need to include it in this class, but it's not something you should really worry about. Not something. It's the TRM guys, which is the Treasury Risk Management guys. They are the one who take care of this cash flow everything. It's not really something that we dwell much on as an FI person. So then this snapshot here is just to give you how balance sheet, your P&L, and your cash flow relate to each other. How, because they are related. Yeah. So if you look at this 2024 year now, in retained earning, I would say your retained earning is the movement of your what do you call it? Your equity. Is the movement of your equity, or let me not call it equity, the movement of your P&L. Your P&L is what comes to your what? To your retained earning. For every fiscal year, your retained earning symbolizes what you have under your P&L. I'll use one example to show it. You see this thing I marked with red check mark, red box, minus 55750. How did you get minus 55750? When we say retained earning is the what? Is the flow of your profit and loss. Now let's look at our P&L, which is this. In 2024, we have minus 15,750 as what? As our net income. Right? We have this as our net income. Now, under our P&L, and we remember we said our P&L is profit and loss. The money you have made against what you have lost, which is your expenditure and what have you. So this is now what we have. So directly, we are supposed to have 15,750 to just come and sit under your retained earning. Since we say retained earning is a reflection of your P&L, right? Your profit and loss, deduction of your profit and loss, or the difference of your profit and loss should just come and sit here. 15,750 should come and sit here. Retained earning, again, let me explain. Retained earning is just profit plus loss. Take that, profit plus loss. So this one now, since this is the net income now, loss, net income or loss, this one should just come and sit here, right? In 2024. However, don't just take it like that. Because in 2023, whatever you have in 2023 will be migrated or will be forwarded or carried forward to 2024. So look at this. We have 40,000 naira negative. So minus 40,000, right? Minus, because this is negative as well, right? This is negative. So minus plus minus is minus. Minus plus minus is minus, right? I'm sure some of us we did mathematics. So we have 40,000, which is negative, and we have a negative of 15,000, meaning that you have a negative of 15,000, you also have a negative of 40,000. So if you put those two negatives together, it will form a negative of 55,750, and that's what this thing means, right? That's why you're having minus 55,750. So these are one of the example of how the profit and loss and the cash flow, how they speak to each other. You can see other net income. Net income also come to your what? To your cash flow. You know, the other time we said your what do you call it? Your other interest tax has been captured in the net income, that we don't need to reflect it again. It's because if you look at your net income, what constitutes your net income? Your taxes has been added to it. You can see taxes has been added, so you don't need to do anything here too again under your cash flow. So this thing is, you can't, it's a robust thing. In fact, managers are the one who do balance sheet. It is not your problem as a financial account, as an SAP consultant. Your responsibility is to the system, how the system should give you correct this thing. You understand? It's not really something you should worry yourself, how they calculate this one, it's not what you should really worry yourself. It's just for you to know how they're also doing it. You understand? But it's not something you should really beat yourself around. Like I used to tell people, myself, I'm not an accountant. I never did the accounting. I did not do accounting at all. While I was transcending from my GS3 to SS1, from GS3 after in my SS1, I went straight to science class. I did not even bother doing anything relating to accounts or what do you call those courses those years? No, I did not do anything with regards to them. So, but and I did chemical engineering. So imagine if I'm a chemical engineer, I'm speaking to some certain things in accounting. It's not as it's over time. It's experience gathered over time. Do you understand? So you also get there. It's just a matter of time. So I think with this, I think we have rounded up the course because, like I said, for everything we are doing from the front end, from the journals, all the journals we are doing is to get to the reporting side. And now we have gotten to the report. We've been able to get our balance sheet. We've been able to get our income statement. We're able to get our cash flow. So, except we have questions to ask, which we'll go back to re-explain. You have the note with you. You can read them up, and if you have any question, you can always drop it on the group chat. We'll be there to give further explanation. We'll give some audio if it requires to do audio to explain what we want to talk about or what you intend to ask. We'll drop an audio there to explain. And we still have other time that you can still raise the questions with clarity with regards to anything that you feel you need to know. So there's enough time. We can still talk about it. But we need to close this financial accounting basics today because we still have four classes to go. We have 4 classes to go, and those ones are to the system directly. By Monday, which is tomorrow, we want to go into the system and begin to look at SAP itself. That's our end goal. We want to master SAP, and we need to master it. So this one is just to give you an overview of the basics, which is very important actually. So, and you can say we structure it to 2 days, and I don't want to go beyond these 2 days. Yeah. So, the time has really run up. I would have gone to SAP directly to just show you 1 or 2, but I think tomorrow we can start. But if you have any questions, you can ask questions, and I'll be very happy to answer you before 12 o'clock. Okay. Kudrat said, yeah, she has question. Skip E for equity. Okay. Okay. So are there questions to ask?
Hello, sir.
Yes, go ahead.
Sir, please, can you scroll down like to the last part? Can you hear me, sir?
I can hear you. I'm scrolling down
Hello,
to the
sir.
last part. Yeah.
Hello.
Yes, I can hear you. Can you hear me? I guess Ghanaian network is bad. While we wait for Ghanaian to ask a question, do we have any questions to ask? Mohammed,
Yes, sir.
yes, do you have any questions?
No, I don't at this moment.
Okay, good. So I want you guys to look at this note we have shared, go through it. Tomorrow we will start with SAP proper. We'll start with SAP proper, and we should brace ourselves up because we must master SAP. And anything that will help us to master it, we must prepare ourselves to it. So thank you very much. I think Gania still has question. So Gania, you can go ahead with
Yes,
your
sir.
question.
Can you hear me now, sir?
Yeah, I can hear you.
Okay, sir, the part where you were explaining the you said that they have something in that they are related to, the accounts are related to each other. So you were now explaining that, that this 2024, to get the retained earning of 2024, you have to go to your P&L account. Then your loss is going to be added to, okay, you minus it from your retained earning of 2023, right?
Good.
Okay,
Yeah,
so
so
to
you
get
know,
that of 2024.
yeah,
Walaikum salam.
yeah, go ahead.
Yes, sir. Okay.
Okay,
So now my question is that if we're preparing the account for the first time, the retained earning, are we just going to take the 15,000 naira, which is the loss? Like in 2023, we made loss of 15,000 naira, right? The total loss was 15,000 naira. Okay. So now, and in our retained earnings, we have 40,000 naira. How is it related? Like you said, the accounts are related to each other, so I don't understand that part.
yeah. So you know, you've been able to plot, you've been able to see something. That's a very good question. That's a very good question. So, however, you know that your balance sheet, for everything on your balance sheet, they are carried forward to the next year. So 2023 now, all the balances in 2023 will be moved to 2024. They'll be sitting in the account before starting any further transactions. Now, you are expecting that 15,000 should be in your retained earning in 2023, since in your income statement 15,000 is the net income, right? You are expecting to see 15,000 instead of 40,000 naira negative. That's correct, right? Unfortunately, we don't have 2022 here now. If we have the balances of 2022, just like your 2024, you should ordinarily think what we have in 2024 as our net income should reflect in 2024, right? As 15,750. Unfortunately, we have a balance carried forward in 2023. And that's why you have your 40,000 here minus 15,750, which is minus negative of 40,000 or negative of 5,750 will make up your negative of 5,750. And that's why you're having negative of 5,5,750. Did you get that?
Yeah. Yes, sir.
Yeah. So to know whether what we have here in 2023 is correct, we need to see balances of 2022. Do you get?
Yes, sir.
Do you understand? Because retained earning, like we said, it's simply
okay. So what if I'm preparing it from scratch? Like the first year is 2023. How do I
Thank you.
this retained earning? Like, okay, sorry, sir, this account you gave us as example, does it mean that it's a continued business? Like it has been in existence. There's still other figures for previous years.
Correct. So, you know, on your financial statement, you're eligible to show maybe 3 or 4 fiscal year. You can't really show all the time you started. Those companies who have started 20 years ago, you won't want to list all the 20 years on the, you want to show maybe 3 years, right? You want to show 3 years on yours. So here now, we are assuming that this account has been existing for more than 2023. But if it's a new account now, just imagine now you want to start a new business and you want to start keeping record, right? Like we said, the first thing that needs to start is donors first. All the transaction, all the keeping records. I've gone to the market to buy this. The transport is something. So you credit your bank, you debit your transport GL. Now you have not bought your inventories, like your fabrics. You've bought fabrics, right? So now again, you credit your bank and debit your inventory account, right? When you now sell, after producing a gown or what have you, the cost of producing those gowns, the needle, the thread, the labor and whatever you have inputted, you have to pass all their journals too. Right? Now you'll be able to now know the cost of producing a gown. All those things are accounting thing. This managerial, that's under managerial accounts. You know, we have financial accounts, we have managerial management accounts. That's another one. Today we are dealing with financial accounting. Now that's why I don't want to go down there. So at the end of the day, you're able to determine the cost of selling that fabrics. When you're not selling, you debit the customer. The customer is receiving now. You're receiving your gown. You debit the customer and what? And you credit your account receivable. Your account receivable is a debit account, right? Because your account receivable is under your current assets. But no,
Sure.
hold on. I'm making some errors there. So when you debit, so the entries that get passed is that when you debit your customer, you credit your fabric, your inventory, because you have produced, let's say 6 gown, and you're not selling one out of, because your gown are inventory, right? They are your stock now. They are under your current asset. Now you want to sell from there. So when you are selling from there, you credit it because you want to reduce that asset now. You credit it and debit the customer now, right? That's what happened. Do you understand? Hello?
Yes, sir. Continue, sir.
So what happens is that, let me show it on the screen. So when you have a stock, let's say you have stock of 10 gown, sorry, stock. Okay. Now you pass an entry, you credit your stock account, and you debit your what? Cost of goods sold. That's what you do. You debit your cost of goods sold. The next leg you now pass is what? You debit the customer now, and you credit your sales revenue accounts. Now, this one now. So now let's continue. So when the customer now makes payment, you debit your bank. The customer is making payment, you debit your bank, then you credit where? You credit the customer. So at the end of the day, if you look at the customer ledger now, you have a debit of, let's say, 100,
Credit.
and you would have knocked it off with a negative of 100. Because you can see these customers, right? They will be nil off. So the customer ledger will be cleared. So you now know that whether the customer is owing you or not. Whereas you have also credited your sales revenue, because revenue has what do you call it? A credit account. So these are the entries that get passed. So you can see a lot of people, you have to keep those records. You have to be passing those ones. At the end of the day, when you now run your TV, remember I was showing you something, a graphical representation of how these things are done. After putting all your general ledgers, then the next thing will not be your trial balance, because you have to see your trial balance and do all the adjustment entry that you need to do. Then the next thing is now starting to plot your balance sheet, your profit and loss and cash flow. Now, in your case now, as you're starting fresh, your retained earning will simply be the net income direct. It should just be minus 15,750, because nothing is coming from prior year when you're starting this year. Do you get?
Yes, sir.
So thank you very much. It's 12:12. I think we have exhausted our time.
Thank you very much, sir.
If there are questions, you can always drop it on the group. If I'm not available, Mr. Innocent can always respond to it. So thank you very much. And let's meet tomorrow by 8 o'clock, 8 p.m. God be with all of us. Bye-bye.